So let us start with revision of the chapter share capital and debentures. Listen, I will give a quick overview of all the concepts in this chapter. This chapter number of sections is more, concepts are easy to understand, not like prospectus chapter. Listen, with regard to this particular chapter, I will fastly wipe out all the concepts one by one. What will be there in that particular section, concept involved. Okay, very fast I will go into the concept. I will complete this. See here, there are, in this particular chapter, there are 18 sections which are important. How many? 18. Don't get scared. There are only 5 big sections, remaining all are extremely small. Okay, chapter length is less, but number of sections are more. Okay, one by one let me explain. See screen. First, section number 43. Section number 43. Listen. Shall we continue? Fastly I will complete. Please listen carefully. Section number 43. Kinds of capital. In a company there are 2 types of capital. One will be the equity capital. Second one will be the preference capital. Equity capital, preference capital, 2 types of capitals are there. Hello, listening? Preference capital, again 2 types are there. Normal preference shares, participatory preference shares. Normal preference shares, participatory preference shares. Again, there are 2 types of capital, share capital, equity share capital, preference share capital. Preference share capital, 2 types will be there. Okay, normal preference shares, participatory preference share. Question number 1. What is a preference share? Preference share name preference means importance. What importance will be given? It will be given importance over equity, over the equity in 2 ways. Number 1, when dividends are paid, first dividend will be paid to the preference shareholders. When winding up time, assets are sold and liabilities are repaid, first preference will be given to the preference shareholder. So tell me, preference shareholders will be given preference in how many ways? Number 1, repayment of dividend. Second one, repayment of capital. Repayment of capital. In these 2 situations, who will be given more preference? That's why the name came as preference shares. How many types are there? 2 types. Preference shares will get, shareholders will get fixed or variable. Answer. If variable also comes along with fixed, we call them participatory preference shares. We call them participatory preference shares. Listen carefully. How a participatory preference share will look like? Company made a profit. Company made profit. We will pay preference dividend. We will pay equity dividend. Even after the profits are still there, on that, these participatory preference shares will have a right. That's what they wanted to discuss in this point. Okay. So, when you read the section, you will find 2 points. There are how many types of share capitals? Everyone. Number 1, equity. Number 2, preference. Preference is of how many types? 2 types. Normal preference shares, participatory preference shares. If you read the normal section, first, equity share capital means other than preference share capital. Preference share capital will carry preferential right with respect to payment of dividend, with respect to repayment of the capital at the time of winding up of company. Okay. Next, in addition to preferential right, if you get extra dividend or extra amount of capital, we call those preference shares as participatory preference shares. Understood the concept clearly or not, everyone in the class? This is the time I allocated for this section. Everyone understood? One last try, tell me, how many kinds of share capital? Number 1, equity. Number 2, preference. What is equity share capital? Any capital other than preference. What is preference share capital? Which gives preference in 2 ways. Number 1, dividend, repayment of capital. What is participatory preference share? In addition to the preferential right, again dividends will be paid. In addition to the preferential right, again capital contribution will be given. Okay, done. I'm taking this. Everyone comfortable with section 43? Next, nature of shares. Share is a mobile property or immobile property. Therefore, shares are transferable from one person to another person. That's why share is a mobile property, transferable. Next section. Shares are of 2 types. Here and there, if you see gone, I'm not going to spend more time on this. Please. Shares are having numbers. numbering will be given. Folio numbers we call. Shares are of two types. Physical shares, demat shares. Physical shares ki numbering will be there. Demat shares ki numbering will not be there. Who have numbering? Physical. I will ask you a question. Okay. Amount in the form of currency note, numbering will be there. Amount in your phone pay, numbering will not be there. Once you convert something into electronic form, numbering concept will not come. I here also. Shares in physical form has a numbering. Shares in electronic form don't require any numbering. Read section 45. Every share shall have a distinctive number, but nothing in this section will apply if you hold in the form of depository. Next. Next one. What is the next one? Certificate. Listen. What do you mean by certificate on shares? Whenever you purchase a share, what is the proof that you are holding it? Share certificate company has to give. What company has to give? Share certificate. I repeat one more time. I cleared CA. Proof is pass certificate, membership certificate, COP certificate. Likewise, I purchased shares in a company. What is the proof? Share certificate is a proof. Share certificate is a proof that I am holding shares in a particular company. Listening? See here. A certificate issued under the common seal, if any, of the company. Share certificate should be signed by whom? Exam certificate will be signed by secretary exam. Like that share certificate, who should sign? Two directors, or if company has company secretary, director and company secretary. Everyone understood the concept? Tell me. What is a share certificate? It is a evidence of holding the shares. What should be there? Common seal. What should be there? Common seal of company. Okay? And signed by two directors or one director and company secretary if the company appointed a company secretary. Next. I lost. When I can ask duplicate share certificate? When can I ask for a duplicate share certificate? I can ask duplicate share certificate in two situations. When I say duplicate, applicable only for physical share certificates. Amount in phone pay. Money in phone pay. It will be torn. Nothing can happen, right? Therefore, electronic shares ki this content will not apply. If the shares are held in which form? Demat form, there is no problem of mutilation, torn, destroyed, lost. Problems will not come. When the problem will come? Physical. Therefore, a duplicate share certificate can be issued if it is proved that it is lost or destroyed or defaced or mutilated, torn, and is surrendered to the company. Okay. Next one. This is the important point that you need to remember. Up here, everyone understood the point clearly. Yeah. If you apply for duplicate share certificate with the intention to defraud the company, then you will be liable under section number 447. One by one, tell all the points. What point we completed? What section we completed? Certificate on shares. What is a share certificate? Evidence that you are holding the shares in a company. Number one. Number two, it will be having the common seal and signed by two directors or director and a company secretary. Am I clear or not? Number two, can I apply for duplicate certificate of shares? Yes. When can I apply? If it is proved that it is lost or destroyed or defaced, mutilated, torn, and is surrendered to the company. Okay. Over. This is the important point we need to understand. Next one. What is the next one? Voting rights. Which section we are in? Section number 47. Are you catching the speed I am maintaining, everyone? Anyway, we'll keep it in YouTube. You can pause and listen again. But the point in physical class, if you listen, that impact will be different, everyone. Now tell me. Point number one. Voting rights is the next section we are going to start with. Listen. I told you in General Meetings chapter already. What I said, whenever I say voting, if it is a poll method of voting, one share will carry one vote. One share will carry one vote. In case of show of hands, one member, one vote will come. Poll method, one share, one vote will come. Understood? This is the first point. That means Members are of two types in a company. Number one, equity member. Number two, preference member, preference shareholding member. Equity shareholders will have right to vote on every resolution. Right to vote on. Preference shareholders will not have right to vote on every resolution. They will have right only in two cases. Number one, which will affect their rights directly. Example, reduction of preference capital. Who is getting affected? Then preference shareholders will get the voting rights. Then the preference shareholders will get the voting rights. Second one, winding up of company. At the time of winding up, who is also affected? Then preference shareholders will be having the voting right. Everyone repeat. How many types of members are there in a company? Number one, equity. Number two, debt. Preference. Who will have voting right? Both will have voting right. Who will have voting right on all the matters? Equity. Who will have right only on certain matters? Preference. What are that certain matters? Which will affect their rights. In that one example, reduction of preference capital. Second one, winding up of company. Listening or not? However, preference shareholders will get right on each and every resolution like equity shareholder if you don't pay their preference dividend for 2 continuous years. How many years? 2 continuous years. If you don't pay the preference dividend, they will get rights on all the matters like a equity shareholder. Okay. First, I want you to read this one. Every member of a company holding equity share capital shall have right to vote on every resolution. Poll method la 1 share, 1 vote will be given. Every member of a company having which capital? Preference share capital shall have a right to vote only on resolutions placed on the company which will affect their rights attached. Like what? Winding up or reduction of the capital. Whatever he said is there or not? Next. Read this point. This is important. Provided that where dividend in respect of preference shares has not been paid for a period of 2 years or more, such class of preference shareholders shall have a right to vote on all the resolutions placed before the company. Had I told this point or not? Tick. Next. 48 you keep aside. Come to 49 first. Come to 49. What is the 49th section? Calls on shares of same class to be made on uniform basis. What is it? Let me first explain. Shall we? Okay. Listen. There are 2 public issues made by company. How many? 2 public issues made by company. First you need to understand one point. Voting right will be given on proportionate paid up basis. I didn't understand. So I will explain one point. Listen carefully. 1 share. Everyone 1 share. 1 vote will be given. Okay na? Wrong. 1 fully paid share ki 1 vote. 1 fully paid share ki 1 vote will be given. Meaning is what? 2 people are there. They belong to public issue 1. They belong to public issue 2. Public issue 2. Par value 10, par value 10. Okay na? Both are of same class. Both came to general meeting. Okay? 6 rupees paid, 6 rupees paid. Equally paid or not? Answer. I am holding 10,000 shares. You belong to second category. You are also holding how many shares? 10,000 shares. 10,000 shares par value is how much? Answer. How many shares I have? How many votes I will get? 10,000 votes I will not get. How much only is paid? 6. 60% voting you will get. How much is your holding? 10,000 into 60%? 6,000 votes I will get. 6,000 votes you will also get. Understood or not? Now, company went for asking second call. Which call? Second call. Call made to the first category people. Another 2 rupees call made. Okay? How much? 8. These people, they didn't ask. Stands at 6. Another meeting conducted. Both of them came. I am holding 10,000 from group 1. You are holding 10,000 from group 2. Same 10,000. I will get how many votes? They see there and answer. Yeah, how many votes I will get? 8,000 I will get. How many you will get? This is the problem. Now automatically disputes will start between both the groups or not. Therefore, whenever calls are made, calls should be made on uniform basis for all. That's why section came. Understood the point? Not everyone. To all the people, you should make call on a uniform basis. Listening or not everyone in the class? So read. Where any calls for further share capital are made on the shares of a class, such calls shall be made on uniform basis on all the shares falling in that class. Next one. What is the next one? Company to accept unpaid share capital, although not called up. Simple answer. Calls in advance. What it is? Can a company take calls in advance or not? If authorized by the articles, it can accept calls in advance. Calls in 6 rupees is the calls made. Same example. How much? All of us belong to group 1. How much is a call money? 6 rupees made. I paid 8. Now we'll get extra 2 rupees key, extra 2,000 votes will they give? For extra calls you paid, you voluntarily paid. For that voting rights will be given or will not be given? That's what you want to say. Shall not be entitled to any voting rights. Understand all the concepts clearly? Yeah? Just take a minute time. Read section number 49 and 50. Are you all comfortable with the sections completed till now? 49-50. Understood everyone? Tell me, voting rights will be given on par value or paid up value? Paid up. How much you pay, that much only I will give. Same applicable also for dividends. Same applicable also for dividends. 10 rupee par value. I called only 8 rupees. Then why should I pay on 10 rupees? Yeah? On the money which is not called. That's why next section came. Understood the point or not everyone? That's all over. What are the sections we completed now? 43, 44, 45, 46, 48, 49, 50. 48 completed, 48 not completed, 49, 50, 51. Understood up to here all the sections? Next one. Don't worry, dead easy section again. What is the next section? Please see there. Applications of premium received on issue of shares. Listen. There is one concept called as a share premium. What is the name of the concept? Share premium. Can the shares be issued at a premium? Yes. Premium amount will be credited to an account called as securities premium account. Credited to an account called as securities premium account. Credited to an account called as this section wanted to tell for what you can use securities premium account. For what? We can use securities premium account. Securities premium account can be utilized for what purpose? Is a question. It can be utilized for 5 purposes. If your company do not follow Ind AS, if your company follow Ind AS under 133, you can use only for how many purposes? 3 purposes. Listening? Sir, then 5 plus 3, 8 I have to remember. 5 you remember, 2 you have to exclude from that. Understood or not? Let us see. First, what is the section we are reading? What to do with the securities premium, not how to prepare securities premium account. That is accountancy. So now tell me, already securities premium is created. For what you can use securities premium amount is a question now. I can utilize it for 5 purposes if your company do not follow Ind AS. What are the 5 utilizations? Let us see. First one, you can use it for bonus shares. Use it for what? Bonus shares. Second one, write-off of preliminary expenses. Write-off of preliminary expenses. Okay. Next one, writing off discount on issue of shares or debentures. Discount on issue of shares or debentures. Next one, premium on redemption of preference shares. Premium on redemption of preference shares. Next one is buyback. Next one is buyback. Read all the five first. Simplified language will tell. First one is bonus shares. Next one is preliminary expenses. Next one is discount on issue of shares and debentures. Next one, redemption of preference shares. And last one will be buyback. Now you tell. What are the five utilizations? Bonus shares, preliminary expenses write-off, discount on issue of shares or debentures to write off. Next, redemption of preference shares. Redemption of preference shares. Which redemption? Premium you want to redeem. This premium use it to pay that premium. Okay. Last one is buyback. What are these five? What are these five? For these five purposes, you can utilize securities premium account. If you are not following the Ind AS, if you have to follow Ind AS, preliminary expenses point fattu. Along with that, preliminary expenses point fattu. After that, premium or redemption of preference shares also fattu. Means what are the three that will be there? Bonus shares, discount on issue of debentures, and a buyback. That is the three. Will you read and remember later? Understood the concept clearly? Yeah? Next, prohibition on issue of shares at a discount. Listen, discount on issue of shares is prohibited. So then how it came in the previous section? Debentures allowed, shares not allowed. For what allowed? Debentures allowed. For shares not allowed. But sir, shares also there in the previous section. Old companies act allowed. Those debentures discount, share discount, if there is any, you can utilize. New companies actually not allowed. Which actually not allowed? New companies actually not allowed. Understood? So first tell me, what is the section we are going to read? Discount on issue of shares. Allowed or not allowed? New companies actually absolutely prohibited. Except under exceptions. What are the exceptions? They are, listen first, let me tell. Two exceptions are there. Exception number one, sweat equity shares. Everyone repeat first. Sweat equity shares. Exception number one. Exception number two, bank loan conversion. I will tell what does it mean. Listen carefully first. First one, issue of shares at a discount. Permitted or not permitted? A company shall not issue shares at a discount. Next, I should not do, but I have done. Then it will become void. It will become void. Third, what are the exceptions? Section 54 is an exception. That's why he said, except as provided in section 54. Section 54, sweat equity shares. Sweat equity shares are issued at a discount. That is allowed. Another thing that is allowed is loan conversion. I will explain first, listen carefully. I took loan from a bank. I am not telling any story, please listen. I have taken loan from bank. I have to pay principal. I have to pay interest. I am not paying. My position is very bad. Financial status is distressed. I can't pay. There is a concept called as reorganization of loans. What is it? Reorganization of loans. Bank will come. Bank will tell, you do one thing. You are not able to pay kada. Do one thing. Convert this loan into equity shares. Whatever the amount due is there, convert them into equity shares. Issue the shares to us. Free of cost. Instead of loan, we will become owners. We will manage the company. Who takes the control of company? Banks will take the control. Understood the overall picture or not? Now again, listen. What I have taken from the bank? Loan. Paid or not paid? Paid or defaulted? Therefore, bank said that convert what into what? Loan into shares or shares into loan? Loan into shares. Such that I will excuse you from payment. You, how much you have to pay? 100 crores you have to pay. Do one thing. 100 crores worth of shares you issue to me free of cost. When I say free of cost, you are charging or not at all charging? 100% discount is there. Did you understand or not? Therefore, that was provided as a exception. Everyone understood the point? If you are not falling under exception, under 54 or under conversion, you are issuing shares at a discount. Issue will become valid or void. Along with that, punishment also will get attracted. Penalties, penalty charts, so you can read. Understood the discount section clearly or not, everyone? Next issue. After that, what is the next one? Sweat equity shares. Sweat equity shares. Listen. Sweat equity shares are issued to employees and directors. Loudly. Sweat equity shares are issued to employees and directors for creating value additions to the company. Meaning what? Listen. Listen. There is a director. There is an employee. Before him, our company generated 100 crore profit. After him, our company generated 150 crore profit. Technically, that extra 50 came after him. Correct or not? That is called as a value addition. That is called as a value addition. Because of a director or employee, if company got any value addition as a token of appreciation, companies will issue sweat equity shares. Sweat equity shares can be given in two ways. Number one, they may give at extreme discount or they may give totally free of cost. Listen, market share is traded at 1000 rupee. Par value 100 rupee. I will give only at 40 rupees discount, but allowed because it is exception under 54. Just now we read. Tell me now, what is the topic we are reading? Issue of what shares? Sweat equity shares. Sweat equity shares are those shares which are given to employees and directors of the company for creating value additions in the form of know-how, intellectual property. For that we will give them shares, either without consideration or with reasonable consideration you may give. Listening the idea behind sweat equity shares concept or not? See there what he is telling. Notwithstanding anything contained in section number 53, a company may issue sweat equity shares of a class already issued if the following conditions are satisfied. First, which resolution has to be passed? Shareholders by passing a special resolution in a general meeting. Next one. That resolution, by the way, I have one question. Issue of sweat equity shares require which resolution? Special resolution to be passed in a? Okay. Now tell me, sweat equity shares issue is a ordinary business, special business? Morning I told you. Ordinary business, special business, special business. Why? There are only 4 ordinary businesses. Okay, na? Sweat equity shares comes under any of the 4? No. Therefore it becomes which business? Special business require which statement? That explanatory statement, you need to write this. The resolution specify means explanatory statement should specify following. Number 1, number of shares, current market price, consideration if any. That's why if you take, write down. If you don't take anything, you need not write anything. And to whom you issued, which director, all directors, any some of the directors, you need to tell. Listening, if your company is a listed company, you have to comply with the SEBI regulations. Comply with the SEBI. That's all. This is the end of this section. One by one, tell me the answer. What shares we issued? Answer. It will be issued to whom? Outsiders, public, directors and employees. Number 1. For creating the value additions in the form of know-how, we will give the sweat equity shares to them. First, approval number 1. Whose approval has to be taken? Shareholders by passing a special resolution in a general meeting. Explanatory statement, 3 things minimum you should tell. Number of shares, current market price, consideration, and the names of the directors or employees. Understood the point clearly? Next one. If your company is a listed company, You should follow not with Companies Act, you should follow with the SEBI regulations. Done. Very good, we completed. 55, you keep it on hold. I have some important sections to discuss. Buyback. Most important in this chapter. Which one? Buyback. Sir, I have 3 main sections. I will complete it. See here. Extremely important 3 sections are there in this chapter. Extreme when I say buyback section came for 22 times in the exam. Means in the last 20 years of exams, around 22 times they tested the question regarding buyback of securities. Okay? Means every 2 attempts, one time a question is coming on buyback. So therefore, I am going to cover 5 sections now. 68, 69, 70. Buyback will be completed. Which one? 68, 69, 70. Buyback will be done. After that, there is another section called as a bonus issue. What is the next concept? Bonus issue concept will be there. That's the next important concept. 4th section. Which one? Bonus issue. Once the bonus issue is also completed, then we will be going into the last stage called as a rights issue. These are the various issues under the Companies Act. Tell me what are the 5 we are going to read and close? Buyback, 3 sections are there. 68, 69, 70. Once completed, we will go into the bonus issue concept. Once completed, rights issue also will tell all the summary of how to write an exam regarding rights. Okay. First, buyback. Keep the heading. Our buyback is very, very important for exam. One by one you write down. 12 points will come. 12 points will complete entire buyback. Remember those 12 points. Don't leave. Write down. First, buyback. Keep the heading number 1. Point number 1. Sources of buyback. Write down. Totally 12 points will come. Please write down. Sources of buyback. Sir, what are the 3 sections we are writing now? 68, 69, 70. All 3 merged together I am writing. Okay. Write down. Sources of buyback. Free reserves. Second point. Securities premium. Free reserves. Securities premium. Fresh issue. Free reserve, securities premium and fresh issue. Free reserves means existing reserves. Securities premium means just now Vietnam securities premium can be used to buy back. Third one is a fresh issue. Means you pay the existing capital by raising new capital. If you remember regular class, I used to tell a big example. Why companies go for buyback, why capital redemption reserve will be created. But this is not the time to learn all those things. Okay. So therefore I am telling you the summary of entire section. Comes in exam, how to write. Listening, question comes in exam for 6 marks. 6 marks question will come on buyback. At the time, what you have to write? 12 points they will expect. These are the 12. Okay? 1 point completed. Tell me what are the 3 sources of buyback? Free reserve, securities premium account, and fresh issue. Next, point number 2. Point number 2. Point number 2. First one is a free reserve, securities premium, and fresh issue. Next one. After that. Point number 2. Buyback must be authorized by articles. Buyback must be authorized by articles. Buyback must be authorized by articles. From this, what you have to understand? If articles is silent, company cannot go for buyback. Next, number 3. Number 3. SH plus SR plus GM. SH plus SR plus GM. What does it mean? Shareholders by passing a special resolution in a general meeting. Next. Next one. Next one, point number 4. Okay, volume of buyback means maximum how much we can go. Volume of buyback. Okay, volume of buyback. Two branches. First branch, one time. Second branch, overall. Means one time how much you can go, on a overall basis how much you can go. Okay, one time, right now, not exceeding 10% of, not exceeding 10% of total paid up capital plus free resource. Total paid up equity capital. Total paid up equity capital plus free reserves. Next, overall, not exceeding 25% of, not exceeding 25% of total paid up capital. Total paid up capital and free reserves. Completed? Next, point number 1 or 2 or 3 or 4 or 5 or 5. Right? No, continue. Buyback do not require special resolution. Buyback do not require special resolution. In the brackets write down, only board approval. Does not require special resolution. Special resolution not required does not mean no approval is required. Whose approval is only enough? Board approval is only enough. Okay, only board approval. If the amount of buyback is not exceeding, if the amount of buyback is not exceeding 10% of paid up equity capital and free reserves. 10% of paid up equity capital and free reserves. Paid up equity capital and free reserves. How many points completed? 5. Sixth one. Shall we continue? Write down. Sixth one. Debt equity ratio should not exceed 2:1 after buyback. Debt equity ratio should not exceed 2:1 after buyback. Debt equity ratio should not exceed 2:1 after buyback. Next one. Point number 7. All the shares bought back must be fully paid. All the shares bought back must be fully paid. All the shares bought back must be fully paid. Okay. Next. After that, all the shares bought back must be fully paid. Okay. Next point. Once the buyback is made, there shall be a gap of 1 year for another buyback. There shall be a gap of 1 year for another buyback. Did you understand the meaning? Means gap between two buybacks must be at least how many years, sir? 1 year. Once a buyback is made, there shall be a gap of 1 year for another buyback. Next important point. Right. Point number 9. Buyback should be completed within. Buyback should be completed within 1 year from the date of passing resolution. 1 year from the date of passing resolution. Okay, point number 10. Point number 10. Point number 10. Once the buyback is made, company shall file a declaration of solvency. Company shall file a declaration of solvency with ROC and SEBI. With ROC and SEBI. With ROC and SEBI. Declaration of solvency. Do you know what does it mean? Even if the buyback is made, still our company is having enough cash to pay its liabilities. We are conforming to the ROC and SEBI. Listen, next point. Point number 11. Write down. After the buyback, this is applicable for physical share certificates. After the buyback, the company shall physically destroy. The company shall physically destroy the shares bought back within 7 days. The shares bought back within 7 days. The shares bought back within 7 days. Next point. Point number 12. Write down. Mark this important. MCQ also they can ask. Where the buyback is made out of. Important. Read and write. Where the buyback is made out of. Where the buyback is made out of. Free reserves or securities premium. Read and write. Where the buyback is made out of. Free reserves or securities premium. Then an amount equal to nominal value of shares bought back. Nominal value of shares bought back shall be transferred to CRR account. Shall be transferred to CRR account. And CRR account shall be utilized. And CRR account shall be utilized only for, you should tell, only for issue of bonus shares. Only for issue of bonus shares. Okay? That's it. These are the main concepts that you need to write from over 3 sections. Okay? Next. Bonus issue also I will show you. Just to see the screen once. What is the concept? Bonus issue. These are all the important concepts one need to understand. See here. First tell me, bonus shares means we will take money or we will not take money. Therefore, from where you pay dividend, from the same you will also give the bonus shares. Except with the small differences. Listen carefully. 1 second. Dividend declaration is a ordinary business or special business? ADDA. Morning you read? ADDA. Second D is what? Dividend. I mean AD D means what? Dividend. Dividend is a ordinary business or special business? Ordinary business require ordinary resolution only. Therefore bonus issue also require ordinary resolution. What is bonus issue? Instead of giving the profits in cash, we will give profits in the form of shares. Profits in the form of? Yesterday I told you one point. Bonus issue can be made instead of declaring dividend. But bonus issue cannot be made instead of declared dividend. Listening? That's the last point in this section. Please read the last point. Bonus shares shall not be issued in lieu of dividend. In lieu of dividend means in lieu of dividend declared. That's the meaning. Understood the point? Next. What are all the important points? Let us see. See there. What are the sources of making bonus issue? From where you can make? Free reserves, securities premium account, CRR. CRR, just now you read that. For what CRR can be utilized? Fully paid up bonus shares. Bonus shares you are issuing. Understood the point? Now tell me. Yesterday only we read dividends chapter. Can dividends be paid out of revaluation reserves? Bonus also cannot be made. Their point. No bonus issue made, okay, which was created out of capitalizing reserves, which are on revaluation of assets. So revaluation reserve can be utilized to pay dividend. Bonus issue cannot be used. After that, there are some conditions. One by one you answer. Common sense required, nothing great. You tell me, I will listen. When company will pay dividend? When it is having profits, when it is not having profits? In general, having profits. When you will make bonus shares? When you are having excess profits. So you will issue what shares? Bonus share. If you have that much excess profit, first pay the defaults. Therefore, if a company wanted to make a bonus issue, there should not be a default in statutory payments. There should not be a default in taxes. There should not be default in employee payments. That's why these points have come. See here. Not defaulted in payment of debts. No default in payment of statutory dues. Understood the point or not? Next. Dividend require ordinary resolution, special resolution. Ordinary. That's right. Recommended by the board. Authorized by the general meeting. First, bonus issue must be authorized by the articles. Next, who should take a decision? Yesterday only we read. Who proposed dividend? Who declared dividend? Who declared dividend? Who proposes the dividend? Who declared the dividend? First time you answered that also wrong. So, who proposes dividend? Board. Who declared the dividend? Same. Who proposes the bonus shares? Board. Who declared the bonus shares? Shareholders. Same. Ordinary resolution. Ordinary resolution. So tell me, what is the first condition for bonus shares? Articles has to authorize. Articles has to authorize. Number 2, proposed by the board, declared by the shareholders. Number 2, no statutory dues. No default in repayment of deposits or loans. Okay. Next. After that, first thing, if you want to pay the bonus shares must be partly paid or fully paid. Logic. Bonus shares means you are giving free. Free again, there should not be payment again. Therefore, when you want to give bonus shares, check whether your company is having any partly paid share. Any partly paid share is there, make them fully paid and then issue the bonus shares. That means when company partly paid shares are there, it is not correct to issue fully paid bonus shares. Listening? Last one, no bonus shares should be issued instead of declared dividend. Understood the concept clearly? One by one, please tell the answers. Point number 1. What are the sources of making bonus issue? Free reserves, securities premium account and CRR. Whose authorization is required? Article. Proposed by. Declared by. No default in debts. No default in statutory dues. Existing partly paid must be fully paid. No bonus issue instead of declaring dividend. Declared dividend. Everyone. These are the points. So the last one, section 62, rights issue. Later you can read. First I will tell you the overall whereabouts, how this concept of rights issue actually works. Listen. Rights issue says like this. Whenever company is going for a public offer, everyone repeat, whenever company is going for a public offer, whenever company go for a public offer, it can't directly go for public offer. First go to the existing shareholders, ask them whether they can give amount or not. If they say yes we can give, then issue shares to them only directly. If they say that we cannot, then go for a public. This is the logic of this particular concept. It's a courtesy call. I always tell this example. Whenever in a family of 4 members, you want to bring your friend to your home for 2 days and he will go again. Just for 2 days, if you want to bring a new stranger to home, we will ask the parents or not. You are directly bringing new people into the company. Don't you have a courtesy to ask the existing shareholders? From that ideology, rights issue started. Whenever company is going for a public offer, till now it is a family of 200, 300 shareholders. Suddenly it is going to become very big. Before you call someone into the company, you should ask the existing shareholders or not. Therefore, whenever company go for a public offer, don't go directly. First give a chance to the existing shareholders. Ask them whether they can give money or not. If yes, take the money from them. Because of taking money from them, you can escape so many costs. Flotation cost, prospectus cost, legal expenses, all these can be escaped. Morning I told, if you issue shares to the existing shareholders of a company, prospectus required or not required? That means you can escape full flotation costs or not. Since you are saving the cost, deduct that amount from the share prices and then give them shares. That's why always rights issue shares are lesser than the market price. Are you understanding the point or not? Listen, rights issue, there are 2 points. Rights offer letter, rights shares on the offer letter. 2 things. Rights offer letter. Listen carefully. You are all existing shareholders. I will not issue shares directly. I will issue offer letter. Which letter? Everyone? What this offer letter is called as? Rights offer letter. In this rights offer letter, we will tell clearly, we want to issue 5,000 shares. Existing company has 15,000 shares. We wanted to issue not again another 15. We wanted to issue only 5,000. That means proportion is 1:3. Proportion is? Means for every 3 shares held by a person, we will issue 1 share. Listening, you tell, I will listen. I am having 90 shares now. I am having 90 shares now. How many shares I will get right? 30 shares I can subscribe now. At market price, lesser than market price. Lesser than market price. Now listen, I will receive what letter? Not answering. I will receive what letter? Rights offer letter. That rights offer letter, I am getting a right to subscribe how many shares? 30 shares. At the market price, lower than market price. Lower than. Benefit to the company is cost. Benefit to me is lower market price. Win-win concept works. Listening? I saw. What is the share price? 1,000. 1,000 into 30 means 30,000 I need. I saw my bank account. I have 1 lakh. Immediately I paid. My offer is accepted now. Listening? Second situation. Another person is there. Okay? He also got an offer letter. He is also holding 90 shares. He will also get 30 shares. 30 into 1,000. 30,000 he also has to pay. He saw the bank account. He has no money. Only 5,000 is there. Can he purchase or cannot? Cannot. He rejected. 15 days time will be given minimum. 30 days time will be given maximum. Minimum 15 days. Maximum 30 days. For what? To accept the offer. To accept the offer. Rejection can be of 2 types. You can tell I don't want, or if you keep silence for 30 days, automatically deemed as rejection. Deemed as a rejection. So tell me, what will be given by company? Offer letter will be given. Offer letter will be given and you have to accept or reject within minimum 15 days, maximum 30 days. Company will decide. It may decide 22 days. Then you have to accept within 22. But minimum time should be given as 15. Maximum should not go beyond 30. Listening? In our example, what I have done? Accepted or not accepted? Offer accepted. Another fellow not accepted because money is not there. Third person is the very important and interesting character. What this person has done is, he saw the bank account. He has only 5,000. But his friend is there. He said, if you don't buy, at least give me a chance to buy. I will buy that lesser price. you can renounce. What you can do? Renounce. You are not renouncing the share, you are renouncing the offer letter. Renouncing the offer letter. Taking that offer letter, he will subscribe to the shares. Then he will get the benefit at least. This is all about rights offer. Everyone understood the concept clearly? Yeah? After going home, just to put a reading of section number 62. That's all. In this, these are the important sections in this chapter called as a share capital. Before you leave, 1 second, don't pack the bags. Listen, I have certain important things to tell. Examination preparation. In order to get 60 marks in exam, how to score? Before going into that, one important thing before,